I'm hopeful, we're cautiously optimistic even, that they would do that in order to set up some sort of what Dr. Judy Shelton has talked about, which is
Hmm.
some sort of gold-backed treasury bonds. That is a way, perhaps the only way, to contain long-end yields while doing all this. Now, that is essentially going back to gold. That's going back to a pre-71 kind of system. And to me, it can't happen at $5,000 gold. It can't probably happen at $10,000 gold, because what will happen is what happened in 67, 68, 69, which is, hey, you Americans are running way too big a deficits. We'll buy the bonds and then we'll demand the gold. And then we're right back to where we were. So I would think if we were going to move in a direction where there's some sort of allowing gold to go higher, followed by some sort of issuance of gold-backed bonds, which would, look at $20,000 gold. I'll buy 3%, 30-year paper of the United States all day long.
Gold is no longer just a safe haven. It is becoming the center of a major global monetary reset, as debt, treasury yields, the US dollar, and China's commodity strategy all collide. Luke Gromen, a macro analyst known for connecting gold, oil, currencies, and sovereign debt, explains that the financial system may be moving toward a new phase where gold plays a direct role in stabilizing government debt. The key idea is simple. The U.S. cannot handle much higher long-term interest rates, and the world may not keep buying treasuries under the old system. That is why gold-backed treasury bonds could become part of the solution. But according to this view, gold may need to rise far beyond today's levels before such a system can work. He suggests that $5,000 or even $10,000 gold may not be enough. A much higher gold price, possibly around $20,000, could make long-term U.S. debt attractive again. We're about to dive into highlights from Luke Gromen's interview. Before we begin, make sure to subscribe to the channel and enable notifications so you never miss our latest insights on gold, silver, the economy, and financial markets. Thank you, and enjoy the video.
Gold has absolutely a role in all of these things. It's a defense mechanism for the Chinese. It's a weaponization for the China. It is a weaponization for the U.S. And historically, it was a weaponization for the U.S. as they wanted it weaker. But now the U.S. wants to reshore. It needs a weaker dollar. It absolutely does. But because we're so financialized, we can't have a weak dollar against yen. And we sure as heck are, we sit down with the Chinese and say, hey, we want you to strengthen the yuan. The Chinese they saw what happened to what we did to the Japanese. There is zero chance the Chinese are going to sit down to another Plaza Accord and go, oh yeah, we'll strengthen our yuan against the dollar and put ourselves into 30 years of, there's no chance. What the Chinese are almost assuredly saying is, fine, you want a weaker dollar? Let gold go in dollar terms. You guys have been leaning on gold the whole time. We've been buying it up. We know we've been buying it up. Let it go. We're using gold. We let the yuan, like, look, if the yuan is, if yuan gold's 30,000, let's say it goes to 50,000 for easy math over the next 5 years, and you want a stronger dollar or a weaker dollar against the yuan, great. We're going to send gold to 50,000 yuan from 30,000 over the next 5 years. You're going to let gold go to 10,000 and get through the gold link, 50,000 yuan, $10,000. That's 5 on the yuan dollar cross rate. That's a meaningful strengthening in the yuan, but it's a compensated revaluation higher than the Chinese. That they would be down for. This whole you're going to take it to 5 and screw you like we did to the Japanese, like that ain't going to happen. So I think that's where this is ultimately going. I think it's really good for gold. And look, you can play that math all. Hey, take it to 12,500. That's 4 if the yuan gold's 50,000. You want to take it to 25,000. That's 2. Great. That's a meaningful weakening of the dollar against the yuan through the gold link, and that's a compensated devaluation. I think that's what's happening.
So you're saying gold is going much, much higher? Just
I think it has
summarize.
to. Ultimately, I think it has to. In the short run, look, everything we're talking about where forced selling of treasuries, there has been some forced disordering of gold from places like Turkey. The Indians are clearly having a problem with their balance of payments. And so, their Modi came out 2-3 weeks ago and said, please stop buying gold, which, oh, by the way, I think it was Indira Gandhi did it back in 67. And when she said, please stop buying gold, it was like, you should be buying all the gold you can get your hands on because they're in trouble. They have a supply issue. So, gold to me is a tale of two stories. It's, in the very short run, it's going to be, you still got a lot of traders thinking, oh, rates are going up. Real rates are going up. I don't want to own gold. And I think wise people that are beyond very short-term focus, I'm not saying traders aren't wise. They're just not paid to be wise. They're paid to trade. If you're a wise person with a longer term focus, you look at this and go, there isn't a Western country on the planet, and really China can't either, that can afford higher rates. There is nothing more bullish for gold in the long run than rising real rates on an insolvent sovereign, because they are either going to go insolvent, which is bullish for gold, or way more likely, they're going to print money to cap yields, which is really bullish gold. We saw Trump talk about that again over the weekend. These days, anything he says, I take, with a big grain of salt, because they're managing, a lot of things at once. And look, the Iran war ain't going well. So who knows? Is it a distraction? Is it not? I'm hopeful. We're cautiously optimistic, even, that they would do that in order to set up some sort of what Dr. Judy Shelton has talked about, which is some sort of gold-backed treasury bonds. That is a way, perhaps the only way, to contain long-end yields while doing all this. Now, that is essentially going back to gold. That's going back to a pre-71 kind of system. And to me, it can't happen at $5,000 gold. It can't probably happen at $10,000 gold, because what will happen is what happened in 67, 68, 69, which is, hey, you Americans are running way too big of deficits. We'll buy the bonds and then we'll demand the gold. And then we're right back to where we were. So I would think if we were going to move in a direction where there's some sort of allowing gold to go higher, followed by some sort of issuance of gold-backed bonds, which would, look, at $20,000 gold, I'll buy 3%, 30-year paper of the United States all day long. And so will a lot of other people. And so that kind of fixes the problem. Then you can cut rates, et cetera, et cetera. So I would think the first step in that process, if we started to go down that path, would be an audit to establish credibility. So let's see. But again, Trump says a lot of things these days, and some of them are even true. So we'll see how it plays out.
Gold is also becoming a weapon in the global currency war. China has spent years accumulating gold while building a system linking the yuan to gold through major trading hubs such as Shanghai, Dubai, Hong Kong, Singapore, Switzerland, and London. This gives commodity exporters an alternative path. They may not want yuan, but they will accept gold. This is why the gold price matters so much for the US dollar, the yuan, oil trade, and global reserves. A stronger gold price could allow the dollar to weaken without creating the same kind of crisis that a sudden currency devaluation might cause. The prediction is powerful. Gold could move much higher because the current debt system needs a release valve. If governments cannot allow rates to rise, they may eventually print, cap yields, or use gold to restore confidence. Let's get back to the interview.
Gold going up was used by the U.S. government to manage dollar strength. I think Besant absolutely understands the net international investment position dynamic I laid out earlier. Too strong a dollar will cause global economic pain and U.S. economic pain. The challenge in that is, as we saw in 2024, too weak a dollar. Summer 2024, we saw the yen start to strengthen, and that started to blow up the yen carry trade globally, which was also bad for everything. So really, since summer of 24, to me, it's been very obvious. Too weak a dollar creates a crisis. Too strong a dollar creates a crisis. So if you need a weaker dollar for sort of everything Besant and Trump are trying to do, how do you get it without creating a crisis? Well, one way you could do it is you keep it in a very tight range by letting the price of gold strengthen significantly, because all else equal, generally speaking, a stronger gold is bad for the dollar, to your point. But if you've got stronger or higher gold while you're doing things that would also normally strengthen the dollar, maybe you can net that out. And it's very hard to prove that. It's very hard to look at the exact dynamics. But I think there's some element of that going on, that gold is essentially being used as a reference point or as the pivot point, particularly as it relates between the dollar and the yuan. Now, the Dixie, the yuan's not in the Dixie, but the Chinese yuan has been remarkably strong against the dollar, given everything that's gone on. I mean, remember, China was supposed to be the most hurt by all this, and yet yuan's strengthened pretty notably against the dollar since this Iran war started. You can see Chinese, U.S. cables from Beijing, from declassified, talking about how the Chinese were stockpiling gold as a way to kill two birds with one stone. That the Americans and the Europeans had always manipulated gold to make the dollar and the euro look better than they were. China's words, not mine, and not even China's words, the U.S. embassy in China's words, not mine. And the Chinese did what I think is the smart thing, which is, okay, you're going to artificially lean on gold and to make your currency look better. Fine, we'll take the gold. And so, gold's been weaponized. Gold is a political metal. People want to treat it like a commodity. It is not. It's a political metal. It's an alternative currency. It's an alternative reserve currency, which we can say because it is now the biggest reserve currency in a lot of countries' reserves. It's surpassed Treasury bonds in global FX reserves. So, has it been weaponized? Yes, I think it's continued to be weaponized, and I think it's both a weapon and it's also both a defense metric. China is screwed unless they get the ability to buy oil and commodities in their own currency. And China's known this for 15 years. And so how do you do that if you want to maintain a closed capital account? Well, simple. You open your capital account on a limited basis through gold. You set up offshore yuan clearing banks in London, gold hub, Switzerland, gold hub, Singapore, gold hub, Dubai, gold hub, Shanghai, gold hub, Hong Kong, gold hub, and you make your currency convertible for gold in those places to the extent anyone runs a surplus against you. If you run a deficit, they tend to run deficits from time to time against oil producers, commodity producers. And that's how you do that. Now, nobody wants the yuan, but all those countries, all those commodity exporters will take gold. And China's let gold float in its currency. In yuan terms, the yuan has collapsed against gold. It's gone from 7,000 to 31,000 since China opened the Shanghai Gold Exchange International Board in September of 2014. And then the last thing you got to do is you got to find some oil exporters who want to sell oil in yuan and really sell it for gold. And they found that in Russia. They found that in Iran. They found that in Venezuela. Now, spontaneously,
the bigger message is that gold is no longer behaving like a normal commodity. It is acting like a political metal, an alternative reserve currency, and a tool for countries trying to protect themselves from dollar risk. Central banks, China, oil producers, and sovereign debt markets are all connected through this shift. If gold is used as a reference point for future treasury stability, currency adjustment, or commodity settlement, then the upside could be far greater than most investors expect. The old system depended on confidence in paper debt. The next system may require something stronger, and gold is already moving into that role. For investors watching the gold market, U.S. dollar weakness, treasury yields, China's gold strategy, and global de-dollarization, this could be one of the most important macro shifts of the decade. We'd love to hear your perspective on the ideas shared in this interview. Leave a comment below and join the conversation. If you enjoyed this video and found value in the analysis, please like, subscribe, and click the notification bell to stay updated with future content. Thank you for watching, and we'll see you in the next video.